Oh, hi there. Last week I spoke about assets, and today I'll be talking about liabilities. My name is Jacques Taljaard. This is usually Practitioner Accounting Services. And if you're new to my channel, on this channel you will find videos on topics such as what is an asset, what's a liability, how do you run your business from an accounting point of view, and how much should you save for tax. Those kinds of topics under the general headings of accounting and tax matters that affect businesses in South Africa. So last week I spoke about assets. Today I will speak about liabilities in the sense that give you a bit more information about what is a liability and why not all liabilities is necessarily a bad thing. So, where do we start? We start with the International Financial Reporting Standards definition of a liability, and that is a liability is a current obligation of the entity that occurred from something that happened in the past, the settlement of which will mean an outflow of economic benefits. Again, a couple of large words, big words, but don't worry about it. I'm nice, so I'll explain to you what it means. The first thing is that it's a current obligation, which means the company now has the responsibility to pay, right? It doesn't matter how they pay, whether they will pay with money, whether they have to give an asset, whether they have to provide a service. The company has a current obligation, right? They have to, it's current, they already have that obligation. Right now, from a contract point of view, it means they have to do something specific. Whether it's a payment, whether it's the rendering of a service, the delivery of a product, or another asset, there is a current obligation. Right? Okay? And it's a current obligation of the entity. In other words, I cannot sign a contract with Vodacom to pay a monthly bill and then the company has to pay for it, so the company can add my entire cell phone contract on the company. That doesn't happen. It doesn't work like that. The company has to sign on behalf of the company, right? It can't be a shareholder's loan. It can't be or a shareholder's liability. It can't be a sister company liability or an employee's liability or a random stranger or a customer's liability. It has to be the company's liability, right? So it's a current obligation of the company that exists because of something that happened in the past. Now, there's something that happened in the past in liabilities cases is quite often the signing of some sort of a contract or some sort of agreement. Now, for an example of a lot of these agreements are a loan agreement, like finance, where you buy a property or a vehicle and you finance it through the bank, right? So a lot of these agreements are those kinds of finance agreements. But you do also have another agreement where the company was started and the company couldn't afford, financing for some of their assets, and as such, then the shareholders or members of the CC or the owners of the company or directors made a loan to the company by acquiring these assets. For example, they needed furniture and they needed a delivery vehicle and they needed equipment. So the shareholders and directors bought all of these items, and now the company have all of those assets, but the company, they didn't buy it. So the contra indication would be a loan account, or the contra entry would be the loan account of the shareholders or directors. So that could be something that happened in the past. Not all liabilities is as a result of an agreement. The shareholders' loans or staff loans or directors' loans are a case in point exception to the rule. Alright? Now, the next option would be the settlement of which would mean an outflow of economic benefits. In other words, in order to write off the liability, to reduce the liability, you will physically have to pay them something. Now, the economic benefits they refer to is usually considered usually some form of currency or cash or an EFT or something like that. But it does also mean an economic benefit could be an asset of some sort, right? So it could be a motor vehicle, it could be stock, it could be delivery of a service for free of charge. In other words, you have to, in an accounting point of view, you might have to calculate a tax return for free of charge, right? So in these cases, the outflow of economic benefits is usually money, but not right. Now, that is a liability. It's a current obligation of the entity that exists because of something that happened in the past, and the settlement thereof would be an outflow of assets or money. Now, having said that, not all liabilities are bad. The problem comes in when you consider a liability, you need to make sure that you will be making more money of that which you use the liability for than the cost of the liability is, right? So the cost of a liability is interest. I've spoken about interest before in this video. I believe it will be this side. I'm never sure with these things, but I believe it will be this side today, but it might be this side. Anyway, I'll link it up at the top there. Have a card there about interest. Now the interest is the cost of a liability, and the higher the interest rate, the more expensive the liability, the more expensive the loan, and the more you need to make, the more money you will need to generate from that finance, from that loan, before you can consider making, or before you should consider making that loan or occurring that liability. A case would be to finance a motor vehicle. If you're going to buy a motor vehicle and this thing is just going to sit in a garage for forever and a day, and you are never going to be making any deliveries with this vehicle, you're not going to be making any, you're not going to see clients, customers making deliveries with the vehicle. It's just going to stand there. That liability is not necessarily a good one. But if you purchase a motor vehicle, for example, and you give this motor vehicle to your sales representative, and the sales representative goes out and generates sales the equivalent of double the motor vehicle's cost within a year, that's a good liability, because your return on the investment would be quite high, considering you have to pay off a motor vehicle over 5 years usually. If you can, if that motor vehicle can be used to double or to increase your revenue in such a way that its own cost is covered within 2 years, maybe 3 years, you have another year or two worth of the asset available that you will be making a profit on, right? So in those cases, essentially, the liability would be a good thing. So the fact that you're using debt, the fact that you're using a liability is not bad. A liability will be considered a good one if you can prove, or if you can use those funds to generate further income for your company. So my name is Jacques Taljaard. This is Taljaard Accounting Services, and I hope you have a great weekend.